Good evening, everybody. Welcome to the Kotak Pre-IPO Opportunities Fund quarterly update for the quarter ended December 2024. The format of the webinar will be similar to the way we've been doing in the past. We will run you through the fund as well as each portfolio company. You can populate your questions in the Q&A window at the bottom of the screen, and we will address those questions at the end of the webinar. We can keep populating the questions all through the webinar, and we'll take up those questions at the end. I'll start off with the fund overview. As you're all aware, the fund we had drawn down, which was a 2,000 crore fund. We drew down the last capital in May of 2024. Currently, the outstanding capital is at 1488 crores, and we have distributed about 455 crores back to our investors. The current MOICs and TVPIs are based off the last valuations done in December of 2023. It's at 1.1x and 1.05x respectively. The distributed value is about 0.23x of that. This is the summary page of our portfolios. The top half is all the unrealized investments, and the bottom half are all the investments that we've already realized till date. Of the unrealized investments, 3 companies are currently listed, which are Swiggy, Tech, and Aadhar Housing. Other companies are currently unlisted and are making their way slowly to the capital markets during the course of this year and next year, hopefully. The current overall MOIC is similar, is 1.07x. There's no change. The only changes are coming only out of changes in the listed stocks, which is Swiggy, Tech, and Aadhar. In December of 2024, we partially exited Swiggy. About 24 crores worth of stock was exited at a price of about 603 rupees per share. Post that, the stock has corrected as the markets have corrected, so is Swiggy also has corrected. And we have halted our sale process at this point of time, and we will resume again after discussing it with our investment committee. The balance, we'll go through each of the portfolio companies one by one. The next slide talks about stress casing our existing valuations, because our valuations were nearly more than a year old. Therefore, a few of the companies which are also in the portfolios of other funds, we have tried to benchmark it to the valuation as they have taken it. For example, Pine Labs, we have it at 1.38x. However, Barron and Invesco have it also in their portfolio, and they are marked it at about 1.23x. NSE, again, we had marked it at about 1.22x, but currently basis where secondary trades are currently happening at about 1,500 rupees per share, NSE would roughly translate over 2.42x. Similarly, PharmEasy as well, though we had marked it at 0.47x, we have stress cased it to show if it were marked at the last fundraise valuation, which is at 4.84 rupees per share, what would be the impact on our overall portfolio. So, basis the changes in these 3 stocks, our overall unrealized portfolio moves from 1.07x to 1.18x, and the overall portfolio moves from 1.1x to 1.2x just by basis these 3 changes, 2 negative changes and 1 positive change in the form of NSE's markup. From a market perspective, Q4 was a good quarter as far as investments are concerned in the AIF segment. We saw growth coming back again, and for the full year, $50 billion of investments was done in the AIF segments, and Q4 saw growth from 9.8 billion to about $13.8 billion of worth of investments were done in this quarter. The deal activity was strong across segments, both as in growth, early stage, as well as in buyout stage. All 3 segments showed significant uptick in deal activity. Exits as well was robust in Q4 24, though was not as much as Q3, but still robust enough, one of the better quarters over the last 2 years. And most of the exits have happened in the IPO and the open markets in this quarter. And that trend was expected to continue. However, the recent correction in the market will slow down some of the capital market activity in the coming quarters. The market correction that we've seen so far, especially on the mid cap and the small caps, has impacted a lot of the IPOs as well. Some of the IPOs will definitely get pushed out if the market correction continues. However, capital flows, the foreign institutional investors have been continuously exiting out from the market. We've seen nearly $11 billion of net outflow in the last calendar year, in this YTD period. And however, that has been compensated by the domestic capital flow, which continues unabated across all segments. The SIPs continue to flow in, and mutual funds continue to invest that capital into the market. So balancing it out in some form or the other, that's why corrections may not have been as severe as if this domestic capital flow was not there. Some of the macroeconomic factors, especially around global uncertainty of policy changes, tariff changes, could prolong this correction. We'll have to wait and see for the next quarter or so. And after that, the expectation is that the markets will stabilize and the capital market activity should resume again. The next, we'll take you through each portfolio company. The first of the company is Pine Labs. Here, from a financials perspective, we're not in a position to give you an update as the company has entered into a silent period. The company is preparing itself to file the DRHP come in the next quarter, and therefore we do not have financials available post September 2024. Once they file the DRHP, whatever information is available in the DRHP is what we will also disclose to our investors. The bankers have been appointed for the IPO process. The flip from Singapore to India is also more or less done and is expected to conclude in March in this month. And the DRHP is expected to be filed shortly thereafter. Because of the silent period, we don't have information on the financials of the company, but the trend that we saw in the first half, and our expectation is that trend will continue in the second half as well. The first half, they had done 185 crores of EBITDA, which is more than the full year EBITDA of last year. And therefore, they seem to be on track to deliver close to 350 to 360 crores of EBITDA for the full year, nearly more than doubling the EBITDA from the previous year. So that will set a good benchmark for the IPO that they're planning in this calendar year. SMT, Surgeon Medical, this is one of India's largest cardiac stent manufacturer. We had invested in this company in 2023, a combination of primary and secondary. The company for the 9 months has delivered revenues of 750 crores and looks to be on target to reach close to 1,000 crores of top line for the full year. On the EBITDA front, the numbers were impacted because of the CE issue that they had, which continued for the first quarter of this financial year as well. But this coming quarter is expected to be a good quarter, and therefore they will deliver growth over the last year for the full year of FY25. The company, SMT, has also started the process of an IPO and has also appointed investment bankers for the same. As part of a pre-IPO round, we exited some portion of our holding, about close to 13 crores of our holding as part of the pre-IPO round. And we will continue to monetize some shares of ours as the IPO process goes on. At this point, we've exited at about 1.35x MOIC, but as the DRHP gets filed, we will maybe look at further monetization over the next couple of months prior to the IPO itself. NSE, India's largest stock exchange. This for the 9-month number, they've grown about 32% on the top line and grown the EBITDA margin as well. The PAT, though, has grown significantly, but it is on account of one-off income or from a sale of an investment of close to 1,100 crores worth of income is included as part of the PAT. Some of the changes in regulation which got implemented from November last week, the full impact of that is not seen in the numbers in the December quarter. That impact will be seen in the Q4 quarter, and which we are already seeing as far as the volumes are concerned. The volumes have dipped, but NSE and BSE both have made some changes in the pricing and therefore the overall impact on the numbers may not be as severe as the drop in volume seen. But we will come to know the full impact of it in Q4 of this year, FY25, as well as in the Q1 of next year, is when most of the regulatory changes that have been implemented, the full impact of that will be seen in those numbers. Expectation is this year, for a full year basis, they will definitely show a growth over the previous year. But for the next year, the growth may not be as robust, maybe muted growth at best for the next financial year. But full impact will be seen only after we see the results of the Q4 numbers. We had invested at about 620 rupees per share. Currently, there are trades happening at close to 1,500 to 1,700 rupees per share. The company has also applied to SEBI for taking permission to go IPO, but there's been no progress on that front. And we'll wait and see how that plays out over the next couple of quarters. PharmEasy is one of India's largest players in the health tech space, the largest distributor of medicines, both online as well as on the online front. They also have a fairly large distribution business through B2B business as well. And they also acquired Thyrocare, which is one of India's largest diagnostic business as well. All put together, the company has shown muted growth across these three segments put together. And EBITDA has also taken a hit as compared to the previous year. This is largely on account of the B2C business as well as the diagnostic business. Both have shown growth. Diagnostic business has grown by about 20%, while the B2C business has shown marginal growth. However, this was offset by the degrowth seen on the B2B side. They've been taking a lot of corrective measures on the B2B front where they have been exiting out unprofitable contracts. Inventory corrections across the supply chain have also been taken, and those hits have also been taken in the numbers. And therefore, the EBITDA on an overall basis has dropped into the negative territory. Management has guided that most of the corrections are behind them as far as the B2B segment is concerned, and expects to get into the profitable segment over the next 6 months timeframe. By June quarter, I think the company is expected to show full company-wide EBITDA profitability. As far as the balance sheet is concerned, one of the biggest concerns with PharmEasy was always the over-leveraged balance sheet because of the leverage that they're taking for the acquisition of Thyrocare. With the rights issue of capital raise that they did last year of 3,500 crores, they had already paid down about 1,000 crores of debt. And the next tranche will come due in this from June 25 to June 26, which also will get either repaid or refinanced using the current cash, as well as lower cost debt that they will take on to repay that loan. I'll ask Nidhi to come in at this point to take the next rest of the companies.
Good evening, everyone. Taking up on Wordsay Innovation, which is essentially two lines of businesses, Daily Hunt and Josh. Daily Hunt is their cash generating business. The company is posting strong EBITDA of 14 to 15% and well supporting the Josh business. Josh, which is the short video format, it wasn't monetized when we had invested, and today it has started monetizing. It has now even become gross margin positive, and with that monetization kicking in, the burn has come down significantly, as you can see on your screens as well. They have also done small tuck-ins, as you can see, Value Leaf, which is a 51% stake that they acquired. It is essentially an ad retargeting business, which is if you, for example, visit a particular site, XYZ site, and then you visit Daily Hunt, then you will start seeing the ads of XYZ company on the daily hunt, presuming XYZ is paying for it. So that kind of ad retargeting also improves the stickiness with the advertisers, which is the bread and butter for daily hunt business. The company has a sufficient amount of cash, about 1,400 crores, to fund the business and for good 2.5, 3+ years. The company, we are awaiting Q3 numbers. We haven't received those, and we will be receiving those shortly in the next update. Next question, slide on Mobile Premier League. This is something which, to be honest, we are very happy with the way the company has performed. It is well diversified, not in just terms of category of the games, but also in the geography wise as well. Today, India contributes 60% of the revenue, and the EU acquisition Game Duel contributes 40% of the revenue and 25% to the EBITDA as well. The company has grown on a consolidated basis at 28%. 9 months itself, they have clocked $100 million of revenue and going very strong. They are tracking much better than the plan as well, and they have had their best ever quarter in terms of revenue as well as on the EBITDA. The India business also is tracking very well, is clocking profitable EBITDA of 18-19%, and even the Game Duel business. So on a consolidated basis, the company is doing phenomenally well. It has about 300 crores of cash, but given they are profitable, cash is just a good thing to have to make those small tuck-ins and increase their revenue and EBITDA items. The high operating leverage is definitely playing out, which is what the premise of the company was when they started out in a multi-category game platform offering. With lesser amount of money spent on advertisement, they are able to see a higher stickiness of the players, and hence much higher operating leverage. Yeah, that's on MPL. Next is we have Licious. Licious, the company has picked up on its growth. FY24, if you remember, the company had clocked lower growth as they were concentrating on the burn. FY25 started with the agenda of coming back to growth. And this is something that they have delivered. 9 months you see is 14%. The last 2-3 months, they have in fact delivered 19 to 20% YOY growth. So the growth is back on track. This at the same time where the burn has also come down significantly. This is all due to bringing in operational efficiencies, reducing wastages, the loyalty programs, and also improving marketing efficiency. The company has also started out in its offline expansion through launching 4 stores in Bangalore, which have shown great offtake. And they have been, breaking even in a very, very short period of time. I think the latest store that they launched was in about 2 months back, which is also broken even pretty fast. For offline expansion, they have also acquired a company called My Chicken and More. The process to acquire and subsume it within the company is happening through NCLT, and hence it is going to be a slightly longish affair. But they should add to the revenue as well as to the EBITDA as well. The company is working steadily towards breaking even its online business, and hopefully in a few quarters they will be able to do so. And then they will plan towards IPO as well, as that's something which the public market also likes to hear. For exit for this company and for MPL and Daily Hunt also, we will be looking towards secondary exit, given our timeline of our fund is ending by January 2027. Sorry, just on Licious, the company is very well funded with 500 crores of cash, sufficient money in the bank for a good 3 to 4 years. Yeah. Next, we go on to our 3 listed companies. Swiggy. Swiggy, in fact, has had a very strong quarter. Food delivery business, now they are pretty much neck to neck in terms of growth, like Zomato. They also improved their profitability. Last Q2 was 1.6% of the GOV. And actually, yeah, Q3 is not here. Yeah, Q2 was 1.6% of GOV, which is Q3 became 2.5%. This is exactly a very similar trajectory, which even Zomato followed. Zomato last quarter was 3.4. This quarter they became 4.3. So very similarly, Swiggy is also following its path. In case of quick commerce business, the company clocked a 88% YOY growth, but the loss widened. Something very similar you would have seen in Zomato as well, where their loss widened from 3 to almost 100. And this will remain for some time, given suddenly a lot of businesses are getting into this space. But given the amount of money that is required and the head start which the top three players have in quick commerce, we expect after some time this competitive intensity to reduce, and the company has sufficient capital which it has raised through its IPO to fund its capex as well as growth. The exit. So we had a small exit in this company. We took out about 25 crores of capital with sale proceeds of 40 crores, which we returned back as well. This was at around 600 rupees price point. We are very bullish on the stock, and so is the market actually. Most of the brokers have a buy rating on the stock. This is exactly how the Zomato story is playing out. If you see over here, starting with its IPO, the company when it reported losses, when the lock-in period got over, the stock kind of tanked, which was also coincided with the market itself also tanking in 22-23, at the start of 2022. And after which, when company kept reporting positive numbers, they reported their EBITDA positive for food delivery. And then, barring some leadership exits and strike, they have continued to, report breaking even at console level and so on and so forth. The stock has just gone back up. Swiggy is also with our various discussions with the market. We are hearing, similar expectations. There, Swiggy has, in its own public statements, have said that their break even is estimated to be by around CY25 end. If that were to happen, we expect a lot of potential in the stock to go up. So we are keeping a close eye on the stock, and we'll take, given our we are in the harvesting phase, we will take out at the right price points, like we did at 600 rupees price point earlier. We will keep an eye out, but given the stock is growing by strong numbers, I think while some volatility is expected in the short term, but in the long term, it is a very good story, and we'll watch out for those price points and take exits accordingly. TBO Tech. TBO Tech, we have a smallish investment, about 50 crores of investment. The company has done very well. They have clocked the highest ever take rate on a blended basis, growing at around 29% in this quarter on a YOY basis. And the quality of growth also came from hotels, which is a high take rate business. And hence the quality of growth has also been very good. Albeit on the back of this growth, their EBITDA slightly declined because they are doing some capex investments, like you would have read in the news, Australia, Saudi Arabia, Israel, Australia, Saudi Arabia, etc. Brokers continue to have a buy rating, the average buy price of about 1930. The stock has taken a hit in the last few days, especially as the market has taken a hit. The stock has also taken a hit, but that's just a last 3-day story. All the brokers we have spoken to and several analysts, they're quite bullish on the stock. After all, this is one company. If you see, it is clocking growth at around 25% plus in revenue clocking EBITDA at around 17%, and that itself is also growing at around 17-18%. Very high free cash flow conversion. The ROCE of the business is around 26-27%. Very rarely you get such stocks, and where the underlying TAM itself is so huge because they don't just cater to the Indian TAM. The target market is across the world. So anybody sitting in, for example, in Spain can be booking tickets for going to tickets or hotels going to, say, Ireland and so on and so forth. So it's a very solid story and a very fragmented market in which TBO Tech is the leader across the world. So from a price point perspective, from the multiples perspective also, we think the stock is very well placed. Barring the last few days of beating down on the stock, we will wait out for a right price point to exit this. It's a small investment of 50 crore. We are currently tracking about 1.7x, and we will get out at the right time. We don't have any lock-in on this. Aadhar Housing is an even smaller investment, just about 10 crore. The company has performed very well again. It is one of the larger affordable housing finance players, and it has continued to clock growth despite being very large, with a AUM of roughly 21,000 crores, and now as of 9 months it is 24,000 crores. It has maintained its ROA of 4%, and a very good credit quality as well. So overall street is also very bullish on this. Their price points are roughly anywhere ranging between 500 to 550 rupees. The stock is also trading at around 380 to 400 rupees. We will exit at the right time. Again, it's a small position, so we will be exiting it, assuming we get a good price point over here. No lock-in over here as well. Yeah. That brings us to our last slide, just to kind of highlight how most of our companies which are heading towards exit, like Pine Labs, SMT, are profitable. NSE, we are all aware of the company. MPL also, when we invested, it was unprofitable. It has turned itself around completely despite all the regulatory issues. And they still haven't got any GST notice as well, by the way, from the government, unlike other companies. TBO Tech, Aadhar are profitable companies when we invested itself. Swiggy has continued to reduce its burn. Licious also on the same track of reduction in burn, same as Verse. API is right now focusing on growth and hence going through a little bit of increase in the burn, although they had broken even in around FY24. Yeah, that brings us to the end. Happy to take your questions. Yeah, so there is a question on how is the MOIC valuation of the companies which are unlisted done? Dheeraj, would you like to take that?
Yeah, so we do the valuations for the unlisted portfolios once a year. And for this year, the exercise is currently underway. It is done by a third-party agency which does it. And we'll be in a position to disclose the numbers to our investors as part of the March quarter update. But it is done by a third-party agency, but it's an annual valuation exercise that's currently underway.
There is a question on why has the fund not exited Swiggy fully sometime 2 months back? At 600 price point or above, we had a certain amount that we wanted to exit because we are fundamentally very bullish on the stock, and also in fact the amount that we had given to be exited also, the price did not stay at that point for such a long time that we could exit even the amount that we had to exit. So it's not like we could exit a 200 crore amount at 600 rupees. Even the amount that we had told our, which was to be exited, that also couldn't be exited because the price didn't stick at 600. We were opportunistic and we took that money out, whatever we could, and gave back the investors. But we are not worried because market is down, Zomato is down, Swiggy is down, and the Nifty mid cap, Nifty large cap, everything is down. But if the fundamental story remains same, we would like to hold on to the stock and just rather than just dump it in the market. Zomato went through the same story as I had pointed out earlier. And Swiggy is also going through the same thing. If they're able to show a profitable or a break-even outcome, we are expecting the stock to go up. Similarly, what this has happened in Policy Bazaar as well, not just Zomato. The market rewards if you're able to show that, and we should not just kind of be very pessimistic that just because the stock has gone down, something is wrong with it. Fundamentally, the stock is doing very good. The fund timeline, there are some questions on the fund timeline, and this is typically a pre-IPO fund, and all pre-IPO funds have a typical timeline of 4 to 5 years, 4 to 6 years, with 2.5 to 3 years of investing and the balance for exit. This is exactly how we are performing. We invested till 2024 May, and then now we have started exiting, and we are exiting now. Some exits we have taken earlier, some exit, and most of our exits are back-ended, given they are unlisted companies. Market also has to play ball, and this is a cyclicality that we have to live with. What we are trying to say is that whether it is Pine Labs, where we invested at $3 billion valuation, the company is doing very, very well. Now, at what valuation will it go? After we invested, there were investors who came in and invested at $5 billion valuation. We invested in Daily Hunt at $2 billion blended. After we invested, there were investments by Ontario Teachers Pension Fund and other investors, Google, etc., at $5 billion valuation. Same thing for SMT. We invested, and there is a markup in the company. And we have also been able to demonstrate that at markup holds good because we have recently exited some amount of it. So the companies are performing. 2022 was a time when funding winter happened. Some companies went through their issues, but they have come out strong from it. Licious took slightly longer. MPL bounced back very fast. And so this is part and parcel of any portfolio where some companies will take time, some companies will bounce back fast, some companies will continue to perform very well. Yeah, so that's on this. Any payouts in this quarter, Dheeraj?
Not in this March quarter. From an exit perspective, obviously there are the 3 listed companies, and we will take calls on when we exit those 3 investments. Other than that, there are 2 IPOs that we are expecting in this calendar year, which is SMT and Pine Labs. Timeline-wise, expect just before Diwali of this year, both our IPOs should hit the market. Obviously, markets being conducive for an IPO at that point of time. And therefore, we will, again, for those also, we'll take a call on how much we exit as part of the pre-IPO, IPO, as well as post-listing exit as well. So those are the 5 companies which may see some amount of liquidity in this year. NSE, again, is a fairly liquid counter. We'll take a call on when we look to exit either this year or next year on NSE. The balance 4 companies, we're expecting the liquidity to come in only in the next calendar year.
There is a question on, can you give a tentative timeline of how the money is expected to be returned over the life of the fund left?
Sorry, I mean, I can give you a timeline on the exits which I spoke about. And anyway, it's only 2 years left, or less than about 21 months left for the fund life. I think roughly half and half. Maybe you can take that half the capital investments will be exited this year, and the balance half will be exited in the next year.
What is your view on API performance and plans for listing? And a related question, what is the share price right now?
Yeah. So API, Farmeasy, numbers-wise, it has been a disappointing quarter. They were We were expecting that the company will start showing growth from this quarter itself, but that has been pushed out to the next quarter as per the management. And from a listing perspective, at this point of time, they're just trying to get back to growth because without growth, unlikely that they will be able to do any listing. Therefore, the plan is to get back to growth, which is expected in the March quarter or the June quarter, June coming quarter. So basis that listing most probably will not happen in this calendar year. If at all there are plans, it will come up in the next calendar year. The management has not guided towards any IPO plans for now. And they're just trying to get the P&L correct and get back to growth at this point of time. The pricing, we're currently holding it. Our entry price, blended entry price right now is at about 25 rupees per share. The valuations that we are currently holding it out roughly about 11 rupees per share. And the last primary round was at 4.84 rupees per share. Secondary trades are happening, but I mean, those are very small quantities at this point.
Any view on the XIRR of the fund?
Again, maybe a little too early to say because we still got about 9 companies left to be exited. And so therefore, I don't want to comment on the IRR at this point.
There are some questions again on why we aren't exiting Swiggy or TBO Tech. As I said, that for every company, whether it is Policybazaar, also we took time to exit because we had a certain price point in mind, and we have delivered that. We have made 1.5x in Policybazaar, same in Swiggy. It is not just it is about having a fundamental price point in mind for us, where we think that the company can from current price point can go up till here. If it exceeds this, let's take the money out, or if it reaches the price target, let's take the money out. If it is in the middle, that means it is undervalued, and then why should we take out money when a company is undervalued? This is something which even mutual fund managers or PMS also follow. And we are cognizant of the fact that we have invested in a company for fundamentals. It is not a trading that we are doing, that we are investing, and when IPO happens, we just have to exit. TBO Tech, we had a lock-in, and the lock-in opened after 6 months in November. And after that, and same for Aadhaar, both of them, we couldn't exit till November, but after November, we can exit anytime, and we will exit at the right price point. We can't tell the price points because that is not allowed by compliance. The fund tenure is only 2 years left, and yes, if Swiggy performs, and that is, if you see the broker targets are all 1-year target for price point of 550 rupees. So question is basically, is the fund tenure sufficient for Swiggy exit? The broker targets are 530 rupees on an average for 1 year from here. Okay. The stock was trading at 500 as the current market has fallen, as you're all aware in your other portfolios as well. The entire stock market has fallen, and so have these 3 stocks, and not just that, their competitors as well. And accordingly, we can't fault a particular company that it will not bounce back from this when the fundamental price for that company is X. And we're not talking about one broker. There are multiple brokers who are talking about this. They have a buy rating. Currently, the stock is trading at, say, 340 rupees. Why should we exit at 340 or something when the stock has the potential to go up to, say, a 530, 540 as per brokers, or even more? Zomato stock, by the way, ran up beyond what the broker's target was when it started posting good numbers. In fact, several of you have actually reached out to us that, and told us that, you hold on to the stock is doing very well. So it is, and we also have a fundamental belief that the stock is a good stock. It is growing at 25-30% YOY. Same with TBO Tech, same with Aadhaar. Why exit something just because the market has fallen? TBO Tech price is valued at 1558 is as of 31st Jan. The 1197 price is as of today. This is a slightly dated deck. This is what we had sent you as well. Any further questions? There's a question on, given the market conditions, how do we expect to exit all the companies with the fund tenure?
So as I said, we have about 21 months to go before the fund life expires. There are a few IPOs already planned. The balance companies, we are already started work on exits through secondary sale to financial investors, and we will take a call in the next calendar year. If we don't see the visibility of an IPO for those companies in the next calendar year, we will exit out to say to another financial investor in the next calendar year.
Realized, there's a question on what's the portfolio realized and unrealized value today. For your, I mean, we have as of for the portfolio. Okay, yeah. So as of for the full portfolio, it is the realized value is, this will be the realized value, right? 455 crores. And the current unrealized value will be 1,600 crores. Yeah, so 1,600 crores is unrealized value, and realized value is 455 crores on an investment of 1979. So we'll have to do it as a base of, you'll have to divide that as a base of 1979. There is a question on, the fund is not performing as per, what we had targeted. And we have repeated this. Yes, we started investing in 2021. That was the peak of the market in unlisted side. We invested in some companies at very high valuation. And then we realized that it's just not making sense. And we paused investment for one whole year. And we could do that because we were charging management fees on drawn down capital and not on committed capital, unlike our peers. We, after investing about 40-50% of our fund, we next invested in SMT in March of 2023, followed by NSE, TVO Tech, etc. So, and in fact, in one of the earlier webinars, we had also shown that we did learn from our mistakes from the first phase 1 of our investment versus phase 2 of our investment. The cycle did hurt us, and that is causing a loss of IRR or time value of money. So yes, we do agree. The fund is not performing as per what we had targeted, and we are victims of the market. But we would like to say something that if we just compare all the pre-IPO funds of the same vintage, they're all having the same issue. But why only pre-IPO funds? Actually, all VC funds. If you take the biggest of the biggest funds out there who started investing in 2021, whether it is, some bulge bracket US funds, they've all taken a beating when they started investing in 2021, because that was peak of the market. And these numbers are public. You can actually go out there and check it, the vintage performance of 2021. In that, to not have companies which had, companies going bust, and companies which had governance issues, or companies which had some fundamental challenges. Our companies, in fact, have performed well. They have bounced back. Some took time, some took a small time, some took longer time. But at least they have bounced back. Look at the way Pine Labs has come back. Look at the way MPL has come back. Pine Labs is now on its path of its IPO. SMT is a profitable company. We'll be able to exit it very soon. Licious took longer. We admit to that. The companies have been performing. Yes, it has cost us time value of money, but this is not destruction of money, unlike some other funds where companies have gone bust for corporate governance issues. There's a question on why not exit in TVO Tech. TVO Tech, we did not invest at high valuation. TVO Tech, we invested at 920 rupees. It is still tracking up well above the IPO. And in the last 3 days, it has fallen. Otherwise, it was tracking at 1,500, 1,600 rupees. And that is something which all brokers say that it's well below the price point it should be. And it's a good number to trade at. And they have been at that price point. If it reaches that 1920 level, that's also a very good price point, because the company is very, very unique. And that's a great find for us. And we could invest 50 crores in the company, which even the anchor investors didn't even get that kind of allocation. And that is what pre-IPO fund stands for, giving you access to those companies which are very, very difficult to get. This was a hugely oversubscribed IPO. This was something which Anchors got at max 32 or 37 crores, and we got 50 crores. I think what the stock selection that we have done with regards to post, in the phase 2 has been rock solid, and the companies have delivered very well on that. Any more questions? Okay, if there are no further questions, we would like to thank you all for joining us on this webinar. Thank you. And we'll be sending a recording of this webinar as well for those who have missed it. Thank you.
Thank you so much.
Thank you.